All right, so we're on step 8, preparation of the financial statements. We left off on the adjusted trial balance after we did the adjusting entries. So now I'm hoping we can finish this process up with this last video. We have the list of financial statements. I wish they had put the statement of stockholders' equity right there because we have to do it to get to the balance sheet and statement of cash flows. Okay, so first thing we're going to do is the income statement. And remember your headings for the income statement, statement of stockholders' equity or retained earnings, and statement of cash flows are all for a period ended. Okay, like they're a movie, like watching from the beginning to the end. Okay, so we're going to start with sales revenue, subtract out our cost of goods sold to get gross profit. Then we have all our operating expenses, and we have operating income of 3,000. Then we had some other income and expense. So we had some rent revenue and we had some interest expense. Okay, so those netted together and then subtracted from the 3,000 operating income, we have net income of 2917. Okay, haven't really talked about a statement of comprehensive income up to this point. They'll sometimes call this OCI, other comprehensive income. This reports some changes in shareholder equity during the period that were not the result of transactions with owners. These are very specific when they end up on comprehensive income. They are not in the income statement yet. Okay. Sometimes they'll just do the comprehensive income just below the statement or the income statement, or sometimes they will break this out into another statement. One thing, don't get confused. They'll always ask you something about is net income included in comprehensive income? And it is because the comprehensive income will start with net income. Okay. I remember that being a CPA question, so why I wanted to point that one out. Okay. So then we have our balance sheet. I guess they're not going to do those, but I'm going to jump down here to do the shareholders' equity really quick because we need this number for the balance sheet right there. Okay, so that's the same number. They just should have put that statement of shareholders' equity up here. So let's come down here. We'll look at shareholders' equity, and here's that net income that come from the income statement. Okay, after we do, this is more of a detailed sort of telling us everything that happened in shareholders' equity. But if you come back up here to the balance sheet, you just see it's just like a summary. Doesn't really give you a lot of information, but it just brings that number right there. Okay. And then our balance sheet balances. Notice they have this broke out between current assets, long-term assets, current liabilities, and long-term liabilities. Okay. Then we're going to look at the statement of cash flows. Okay. We haven't um, gotten into too much depth in the statement of cash flows, and we really won't so much here because I think that's coming up in one of the next chapters. Okay. Remember, there are three categories in statement of cash flows: operating, investing, and financing. They're always in that order every single time when you're doing a statement of cash flows. Okay, so they got an example here for us. This looks like the direct method, which is not used, but it is still tested on CPA exam. So I'm sorry about that. We will learn both of those in a, a chapter coming up. Okay. So then, after the financial statements are done, we're going to go through the closing process. Okay. So it sort of serves as a dual purpose. It zeroes out all the temporary accounts, and then the temporary account balances are closed to retained earnings. Okay. So it just gets us ready to start over for the next period. Okay. So the closing entries, the things you're going to close out, revenues, expenses. If they used a temporary account called dividends, those are the things that will get closed. And remember, when we had a sole proprietorship, we closed all of those to owner's equity, the one owner's capital account. Well, we have lots of owners now, so all of those get closed to retained earnings. Okay. Real quick, I want to give you the T account for retained earnings and what goes in it. I may have done that already, but I wanted you to see it again. Okay, because it can get kind of confusing, especially when you're doing statement of cash flows. They may expect you to be able to back into some numbers. Okay, remember, we hope that retained earnings has a credit beginning balance. We would add net income. That would be on the credit side because that would be increasing retained earnings. If we had a net loss, that would be over here on the debit side. Dividends that get paid are on the debit side of retained earnings. We hope that we have an ending balance on the credit side, but this is one of those accounts that could actually flip over to a debit balance, especially if we have a lot of net losses or we pay too much dividends. Lots of businesses have net losses for the first several years. I believe Amazon was one that had losses for maybe like 6 years or something. But hey, look at them now. And sometimes, a lot of times that happens in a new business. You're going to have some net loss and it may flip over like that. It's okay as long as you're gradually trying to get back to the getting out of a deficit in retained earnings. Okay. So, first thing we're going to do in the closing process is to close the revenue account. Okay. So, we're debiting the revenue account. So I'm going to draw one T account out really quick for sales revenue. Sometimes it helps to see this. Okay, sales revenue had a credit of 38,500. It's a temporary account, so we're trying to make it zero. So we're kind of going backwards, but that's okay. Remember in the closing process, so it kind of looks like we're rewinding. Okay. So all of your revenues will be debited and then retained earnings would be credited. Sometimes they'll use that temporary account called income summary. We use that in principles. They could use it. It doesn't really matter either way. It probably this saves another journal entry by taking it straight to retained earnings. Okay. Remember all of your expenses. So let's look at cost of goods sold. It had a debit balance of 22,000. All of your expenses have a debit balance. If we want to zero those out, we have to credit all of those expenses. So you can see we've credited all of those expenses and debited the retained earnings. Okay. Then the third entry, we had those dividends and we're closing those dividends to the retained earnings. Okay. So the impact on retained earnings, which they did this back over in that statement of shareholders' equity, um, that number popped up. So this is the good thing is you have lots of check figures when you're going through this process. So that ending retained earnings should be the same after you do that closing process. Okay. Then they want you to prepare a post-closing trial balance. I don't know that anybody actually does this because if you do, the only thing left is your assets, liability, and equity. What is that? That's your balance sheet. So it's basically your balance sheet. I think we could probably grab that total from the balance sheet right there. Okay. So they throw it in here as a step, but I don't think a lot of people actually prepare a post-closing trial balance because it's going to look exactly the same as the balance sheet. Okay. All right, so now we're going to kind of talk a little bit about converting from cash basis to accrual basis. Okay, kind of almost touching a little bit here on the statement of cash flows. So to we're looking at cash basis. Accrual measures the entity's accomplishments, resource sacrifices during a period, regardless of when the cash came in or out. Okay. Cash is still important, so we want to look at the cash basis. So we want to look at cash collections minus cash payments from operating activities. Okay. So right here, they told us, suppose that a company paid $20,000 cash for insurance during the fiscal year. You determined that there was a 5,000 in prepaid insurance at the beginning of the year and 3,000 at the end of the year. So you can determine the accrual-based insurance expense for the year. I am going to draw a T account out because you may remember my use and source rule that comes into play right here. That beginning balance was 5,000. We don't really need all that stuff in between. We can look at the beginning and the ending, and we can see that it changed by $2,000. Remember that use and source, that's a use of cash right there. Okay. So then if they wanted to, oh, that's not the same one. Okay. All right. So that is transferring that. This is a different one. So let's look at it. I'm going to write out that salary payable. Oh, they already have the salary payable. T account down there. So suppose a company had 150,000 for salaries to employees during the year, and you determine that there was 12,000 and 18,000 in salaries payable at the beginning and end, respectfully. Okay. So beginning salaries payable was 12. The ending was 18,000. And the indirect method, that's what I was doing over here in these T accounts. The change right there was 3,000. Okay. We're trying to find that cash paid. So you got to think about what's going on in this salaries payable. That's why the indirect method is a lot easier. And I did that math wrong right there. There it is, 6,000. Okay. 6,000 minus that 150,000 gives us that cash paid of 150. Okay. All right. I'm not gonna do that one because we've got some statement of cash flow stuff coming up in other chapters. You have access to these PowerPoint if you want to come back and work some of these little concept checks, you can do that. Okay. Here is the worksheet. Okay. The worksheet, I kind of talked a little bit about that earlier in this chapter. Just because we have adjusting entries right here in the worksheet doesn't mean they're in the accounting system. This is just, you just think of a worksheet, it's an Excel document. You're working through these adjusting entries, and then you'll go and take all of those and put them into the accounting system. It just really helps you get through this process of doing the adjusting entries, then having an adjusted trial balance, and then right, no, let's see here. Right, if you draw yourself an imaginary line between, I can't draw a line, between that sales revenue and dividends. Notice right here, everything up above that, our balance sheet slash statement of stockholders' equity, everything below it is income statement. Okay. I probably will not ask you to do a worksheet on an exam. That's a lot. Okay. But notice right here, to balance those two columns, we had net income. All right. So I won't ask you to do a worksheet on a test, but if I gave you all these balances, they didn't give us the balances right there. If I gave you those, if you need something on this block and that one, you know it's net income. If you need something here to balance it out, that's your net loss. Okay. Notice that 2717 is the number we got from the income statement. Okay. We are not going to do reversing entries because hardly anybody ever does reversing entries. So that is the end of this chapter. I'll see you in chapter 3.